Huge economic collapse coming cannot be stopped. While the media has been busy issuing doomsday scenarios, economists have been offering their own opinions on the current state of the global economy. Raoul Pal, the CEO of Real Vision, which offers unrivaled access to the most comprehensive insights and analyses from the most experienced financial experts, claims that the economy is experiencing a traditional recession with credit contraction, and the current global economic crisis will be similar to the 1990 recession, with interest rates rising and yield curves inverting. In addition to being an expert in economic history and investment strategy, Pal offers expertise in business cycles. And in this video, Pal explains the current economic situation and why the coming collapse is more akin to the 1990s than the 2008 financial crisis. Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. Raoul Pal claims that every single banking crisis has the same outcome: swift emergency rate cuts. Doomsday scenarios are being offered up left and right as the banking crisis unfolds. But economist Raoul Pal offers a more optimistic view of the situation. Although many people have called for a 2008 redux, Pal insists it will never happen. In 2008, asset prices severely declined, triggering a collateral spiral. Pal added that after quantitative easing, it took around half a year for collateral prices to become stable, which allowed debts to become more manageable. Furthermore, he noted that before a system-wide collateral is called, QE debases the currency and causes inflationary pressure to increase. Debasement, according to Pal, is lowering the value of the currency. Moreover, Pal pointed out that this is precisely what is happening right now. With the Fed's balance sheet expanding rapidly in a financial crisis, collateral prices are increasing. He claimed that equities, bonds, cryptocurrencies, and gold are rising commensurately. According to Pal, QE is debasement and does not increase asset liquidity. Instead, it adjusts prices to reflect the lower purchasing power compared to scarce assets. Pal highlighted that with QE, consumers might invest less per dollar in all assets, including houses, stocks, gold, and cryptocurrencies, since the price-to-earnings rises, but wages and earnings remain stagnant. With yield curves inverting and interest rates rising, Pal claims the current crisis is more akin to the 1990 recession than the financial crisis of 2008. Pal further remarked, "My guess is we come out the other side when we go into recession. We may reach the bottom this quarter and the recovery will be slow." Furthermore, as per Pal, the trend rate of the GDP is currently low and the banking crisis won't immediately end. However, giving money to numerous large banks and putting them on other people's balance sheets would not solve the problem. It will have to fall apart the traditional way, with everyone getting into a frenzy over the insolvencies of some institutions, whether it be with deposits or their books. Additionally, Pal said that the changes we witnessed in a 2-year bond looked like a drop in the ocean compared to the changes in the 2-year bond yield after the collapse of Lehman Brothers or after 9/11. In this sense, the bond market is screaming, and when it is screaming this loudly, you must never bet against it. Typically, a decline in the value of your collateral would cause you to become bankrupt, but QE prevents this by making the value of your collateral appear to rise. But if your collateral holds up, everything will be fine. Thus, Pal thinks the current market condition won't ever get as awful as in 2008. Meanwhile, the previous action taken by the Fed was effectively a new loan program designed to provide support for the United States Treasury market. Since 2008, they have been assuring banking firms that the U.S. Treasury market is the safest in the world, and these institutions have been told that they must back this claim. Also, they have been advising banks to include Treasury securities in their portfolios of high-quality liquid assets, necessitating the intervention of the Fed to maintain the integrity of the Treasury market. In that regard, it is similar to what transpired in the UK during the autumn of last year, when the central bank was forced to act as a backstop. Since the Fed has now backed the US Treasury market, Powell asserts that the current market environment won't develop into a collateral crisis, but rather a significant transfer of deposits from small and medium-sized banks to a limited number of very large banks. Hence, once this crisis is over, the US banking sector will resemble the European banking system. After that, Powell continued by saying that the Fed needs to print more money and that collateral prices will climb. In contrast to 2008, the debt is not called at a system-wide level if the collateral is worth more. QE is not inflationary. However, fiscal policy is, and it is temporary as demonstrated by Japan, which has experienced this situation numerous times. Moreover, demographics and debt levels are the primary forces shaping the trend rate of inflation. And according to Powell, this phenomenon is caused not by an influx of money into equity markets, but rather by debasement due to an excessive amount of liquidity entering the system and making it possible for individuals to make purchases. On the other hand, Powell has stated multiple times that the recession we are currently going through is more comparable to the recession that occurred in 1990. That period saw a 20% decline in the stock market, a crash in bond yields, a shaky banking system, a 4-year recovery period for commercial real estate, and a prolonged period of job loss. Despite this, many individuals claim that the crisis we will be in will be similar to the financial catastrophe of 2008 or 2000. Powell, on the other hand, disagreed and maintained that the economy is experiencing a traditional recession with credit transaction that has led to an overhang in some sectors of the economy. Because commercial real estate is dependent on small banks, this crisis will bring the US down quickly and make its recovery difficult. Moving along, we are all aware of the fact that demand always trumps supply shortages. Industrial production slows down whenever there are too many inventories, and if there are too many inventories, industrial production in Asia also slows down. In fact, commodity prices are currently declining on a yearly basis. However, Powell claimed that he has not come across any evidence to support the idea that inflation is sticky and thinks this is a false narrative. As the banking system begins to show signs of stress, market expectations for what the Federal Reserve will do next with interest rates have shifted once again. With intensifying indicators of upheaval in the global banking industry, the Federal Reserve's original plan to raise rates by yet another 50 basis points at the end of its meeting has been challenged. Following Fed Chairman Jerome Powell's hardline congressional speech last March 8th, the odds for a half-point rate increase surged to almost 80%. But those bets vanished in a matter of days, with the likelihood of a 50 basis points move falling to less than 2%. Prior to the March FOMC meeting, Fed Chair Powell has been projecting a 50 basis points increase. However, rising consumer awareness about the banking sector's stability over the past months has led to a more cautious outlook for monetary policy. As the Federal Reserve of the United States raises interest rates, the financial system begins to crack, ultimately leading to a crisis. Financial catastrophes have become increasingly common, from the 1980s Latin American debt crisis, the 1998 long-term capital management hedge fund crisis, the 2000 tech bubble burst, and the 2007 U.S. subprime housing crisis. However, after the sudden collapse of Silicon Valley Bank and Signature Bank, the second and third largest bank failures in the history of the United States, regional banks in the U.S. have been under significant pressure ever since. Later on, the news broke that Credit Suisse would require a financial bailout after a prominent Saudi investor declared that it would not provide financial support to the struggling Swiss lender due to concerns regarding regulatory compliance. In order to help stabilize liquidity conditions, the Swiss National Bank was compelled to intervene with a $54 billion bailout. At the upcoming meeting, Powell anticipates that Powell and the board members will opt to raise interest rates by 25 basis points, while also signaling that additional rate hikes will be put off for the time being. With the world economy in such disarray, this would mark the end of the Federal Reserve's year-long cycle of monetary tightening. Powell also added that policymakers would highlight that Powell is prepared to offer additional liquidity measures if needed, and that they are closely monitoring any indications of increased instability in the financial sector. Hi, we hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.